I think we should be live here. So I'm hoping that everything is working as planned here. So welcome to one of my pages here. You're either in the Retirement Coach group or maybe you're in our Keep It Simple financial planning page. But my name is Jason Hamilton, and what I want to do today is hopefully bring back some of the stress you might be feeling about the markets back down to reality, and try to get you to focus back on that long-term picture, okay? The long-term picture, that's the key for today. So for those of you that don't know me, my name is Jason Hamilton, and I'm the founder of Keep It Simple Financial Planning. I'm a certified financial planner, and I've been doing this just over about 6 years now. So we really focus on helping clients optimize their overall retirement plans, their tax planning, and their investments. So if that's something that you're focused on today, especially around retirement and this currently stressful market, then you're probably in the right place. So what I want to talk to you about today is the cost of trying to time the markets, and also some of the essentially the performance of the markets after the year where we might have a little bit of a downturn. So I don't know if you've noticed, but maybe you can let me know in the comments. Has anybody noticed their accounts are down currently in this current market? Hopefully you're not stressing out too much, but I think there's a lot of people that are feeling a little bit of pressure here, especially those that are very close to retirement or just enter retirement, around the current market situation, the world as a whole. Okay, there's a lot going on in the world, but what I want to try to get you to do today is to focus on the long term. Okay, that's the key. And the other thing is, I don't want you to make any bad short-term decisions. So we're going to talk about a little bit about timing the market, and then also what could happen if you take your money out of the markets and what you might miss out on going into next year. So if anybody can let me know if the sound's coming through okay and everything's working properly, that would be great. I'm going to take a look here at any of the comments, but if anybody can let me know, that'd be wonderful. And if we're having any problems, hopefully my assistant Jeanette is watching and she can send me a text and let me know. So on that note, folks, we're going to dive right in today. Let's talk a little bit about the cost of trying to time the market. So as I switch over here, how many of you right now are thinking about taking your money out of the markets? Okay, how many are thinking about taking their money out of the markets? I would love to know that. So good. Looks like everything's coming through good. Thank you guys for the comments here. Very helpful. Wonderful. So is anybody thinking about taking their money out of the markets right now? Should you pull the plug? Is it too late? Should I take my money out and put it to the sidelines to see what comes next? Anybody thinking that? Good. Patrina says she's going to write it out. 62 and retired 3 years ago. Beautiful. David, nope. Joan, no. Okay, wonderful, wonderful. So there might be people here, okay, that are stressing a little bit more than some of the folks here. But I want to reassure you that, honestly, sure, you could try to time the market and maybe you'll get it right, okay? But don't forget, we have to be right twice, okay? We have to be right 2 times. You have to be right when you take the money out, and then you have to be right when you put the money back in, okay? So that's 2 times you have to get lucky. So the question is, do you feel lucky punk, as Dirty Harry would say? All right, so let me pull up some information here. Let me pull up a couple slides to share with you to try to hopefully bring some of your stress levels down, if you're one of the ones that's stressed, okay? Yeah, someone says maybe some, okay. So let's talk about this a little bit. What we're looking at here is the returns of the Russell 3000, okay? So what the Russell 3000 is essentially the S&P 500 plus the small cap index, which is about another 2,000 companies. So we're looking at about 3,000 companies. I don't know the exact number. It might be 3,300 at this point. But you can consider this the broad U.S. stock market benchmark. Okay, this is the whole U.S. stock market, all of the stocks that are included there, basically. So when it comes to this here, if you would have had your money in the last 25 years, and this goes through the end of 2021 here, and we're looking at about a 25-year period, okay? 1997 to 2021. And this is the growth of $1,000, okay? So if you put $1,000 in the beginning of 1997 and you left that money until the end of 2021, that $1,000 would have turned into $10,367. And so can you actually let me know if you can see my slides as well? That is something I am just double checking here. I want to make sure the slides are coming through because I've done that in the past where I will sit here and I will talk about my slides, and then there'll be nothing coming through. Okay, good. Looks like we're good. Okay, so if you left your money alone at the end of that 25-year period, that $1,000, this is the beauty, okay? This is the beauty of investing your money and being a U.S. citizen or somebody who's qualified to invest in the U.S. stock market. They don't have this system in other countries, all right? These last number of years, I've been doing quite a bit of travel. And when you go to countries like Peru or Mexico, they don't have a stock market the way we have it here to invest in. So we have to be very grateful for the blessings that we have here with this ability to just put our money in somewhere, literally forget about it, and look at it 25 years later, and it turns into 10 times the amount we started with. Okay, it's a pretty interesting concept if you think about it. But if you would have missed just 1 week, okay, the best week ever during this last 25 years, which was the week ending on November 28, 2008, that $10,367 would have turned into $8,652, okay? So just by missing the best week, you would have had almost 20% less money at the end of 25 years, okay? So that's kind of a big deal, right? It's kind of a big deal. So we don't want to be missing time in the market because we are essentially getting nervous or getting stressed out or whatever it may be. Okay, so that's 1 week, all right? If you missed the best month, okay? If you missed the best month was month ending April 22nd, 2020. If you missed the best month, just 1 month, then your $10,367 would be only worth $8,279, okay? So again, I'm not here to give you financial advice, and I should mention this, by the way. This is for educational purposes. This is not to give you financial advice. I'm not telling you to do anything with your money, okay? This is your money. All I'm trying to do here is show you the data, okay? So for any of you that's thinking about taking their money out, now, if you would have taken out for the best week, okay, you lost about just under 20%. The best month, you've lost over 20%, okay? Now, if we were to take out the money and just leave it out for 3 months, okay, that $10,367 has now gone down to $7,308. So that's about a 30% loss in total assets, okay? So this may not seem like that big a deal. Oh, you only lost $3,000. But let's add a couple zeros on that, okay? Let's say instead of being $10,000, we're looking at $1 million. So that means your $1 million would only be worth $700,000. Who here could benefit by having an extra $300,000 in their retirement account? I think I could, right? So I think most of us could. And so that was the 3 months ending June 22nd, 2020. And if you took your money out just for only the 6-month period, the best 6-month period that was ending September 4th, 2009, you have now gone from $10,367 down to only $6,728, okay? So that's a big deal, okay? And I have to remind you, as it says here, there is no proven way to time the market. Targeting the best days or moving, the sidelines to avoid the worst is just not a good idea, okay? The evidence suggests that staying put through good times and bad is the way to go. Does that mean you should have all your money in one index, for example? I don't think so. Okay, I think you should have your money spread out between not only U.S. stocks, you should have some international stocks, you should maybe have some real estate type investments, real estate stocks, and you probably want to have some sort of bonds or fixed income portion of your portfolio. Having all of those in there will definitely reduce the overall volatility of your portfolio. So this is a simple example of just trying to time the market and possibly taking your money out for, and missing the best week, month, 3 months, or 6-month period, okay? So any questions on this before I switch over to the next slide? And is anybody willing to admit that they timed the market in the past and had a bad experience, right? Maybe you had 2008 and you took your money out and you end up losing a lot. That's sometimes we need to admit our sins, okay, to recover from those. But I do like, I can't see the name here, but it says, no, they're going to be increasing their contributions. So this is interesting, right? Market's down. I don't know what your portfolio is doing, but it's probably somewhere between 8 to 15%, somewhere in that range, maybe 20%. If you have a lot of tech stocks, by the way, I think the last I looked a couple days ago, Netflix over the last year was down 60%. Facebook was down 40%. Amazon down 30%. So this is key, right? Because these companies have done really well over the last decade or so. But in recent times, these companies have had massive downturns. So if you're somebody who is highly concentrated in any particular one stock, this is hopefully a lesson for you to learn to diversify, okay? And if you need help with that, let me know. I'm happy to help you. So anyways, so Diane admitted she took her money out, okay? Diane, it's good for you to admit that. I'm glad you can be honest about it because that's how we learn and, commit to not doing that again, hopefully, all right? So that's the cost of trying to time the market. Now, let's talk about some positive things here when it comes to how history shows that stock gains, how they look after there's big declines in the market, okay? So what we're seeing here is you're going to see the time frame here is from July 1st, 1926, to December 31st, 2021. So what this chart is aiming to display here is to talk about sudden downturns, okay? I understand that sudden downturns can be unsettling, but, at the end of the day, is Apple still selling a bunch of computers and iPhones? Did you order anything off Amazon in the last 30 days? I've been ordering a lot more on Amazon than I have from going to the store, by the way. Are you still doing Google searches, right, where Google can sell advertising? Okay. So if that's the case, then it's more than likely these stocks are going to come back at some point. Do we know when? Absolutely not. We don't. But the reality is, I understand it can be an emotional experience to have your accounts drop, especially if you're close to retirement, okay? And if you're really tech heavy, tech sector, and you're feeling it a lot right now, okay? I know that for a fact. Tech stocks are down maybe 60, 70% in some areas. So again, good buying time potentially. So what we're looking at here is we're tracking a broad market index since 1926, okay? This is the total U.S. stock market again, like we talked about before. So what we're going to look at here is what happens to U.S. stocks about the returns over periods of 1 year, 3 years, and 5 years following steep declines, okay? So that's what we're going to look at here. So what are the returns of the market after a 10% decline? So we're over 10% at this point. We haven't been over 20 yet, okay? So that could still be a possibility, but we're not over 20 yet. But generally, after 1 year, the average return, the normal return after 1 year being down at least 10% for the following year is 12%. So what's the average market return? Can anybody tell me what the average market return has been over the last, 50 years or so? Give me a good example in the chat there. Can anybody tell me what the last 50 years or so, what is the market return? What's the expectation on average of the market? I would love to see somebody type that in the chat. And if you don't know, I will tell you, but I'm going to give you just a couple more seconds here because I know there's a delay between my voice going to the internet and down. So yeah, 11.8, 10.5, it's about 10%. Yeah, so Sean's pretty close there. So it's about 10.5, 11.8, I think that would include like the small cap index. Yeah, about 10%, Janelle says. So it's about 10%, okay? So generally, after the market has a decline in 1 year of 10% or more, then the next year is generally going to be higher than average, okay? Grace and James, the 7 and 8%, if you look at that over a whole really long period of time, that would be more like the compound annual average return, but the overall average is about 10%. Okay, so, but after 3 years, okay, 3 years is here in the green, after 3 years, we're generally having a total return of about 34.5%, okay? So if you take your money out today, you could be giving up a 34.5% return over the next 3 years. And then the average return over 5 years after a 10% decline is about 68.8%. Okay, so this is where, again, I'm not telling you what to do here. All I wanted to do was just hop on here and give you a little bit of reassurance, even though it sounds, I try not to watch the news too much, to be honest with you. But I've been paying attention lately, and I don't know about you, but it feels like the world is just going through a massive shift. Parts of the world feel like it's ending, right? A lot of things are ending, and I think we're going to a whole new world of a lot of potential good, but we're still dealing with things like, the Russia-Ukraine situation. We got potential food shortages that we might have to deal with. There's a lot of things going on, okay? So that's real. That's all real. But there's been a lot of things going on over time, and these are the returns over the last nearly about 95 years or so. So again, try to stay focused, all right? So if we get to the place where we're having a 20% downturn, then we're looking at more like an average return of 22.2% the next year. Over 3 years, about 41.1%, and over 5 years, about a 71.8% return. So I try to tell my clients that even though you don't like experiencing downturns, it's still good to have downturns every so often, because generally the longer we go without a downturn, the bigger that correction is going to be. And I think a lot of people forget we have, as humans, what's called a recency bias, right? Where we're we get really attached to what we've seen and felt recently. And prior to 2008, when we had the money printing machine that turned on in the US to bail out the banks, we used to experience about a 10% decline on average about once per year. That was pretty normal. But since 2008, we've just seen things go up and up and up and up. And so that's been now 2022, about 14 years or so. We have been very used to the market just going up and up and up, and we've seen a couple dips, okay, but nothing really that major. So keep in mind that we printed how many trillions of dollars? $5 trillion, maybe $7 trillion, depends how you look at it, over the last few years through the coronavirus. We're going to talk about inflation in a second, but when you print that much money, all that money is going to flow into these big companies, right? It's going to flow into Target and Walmart and Amazon, and it's going to flow in, and those stock prices are going to definitely shoot up, okay? And then when the money spigot turns off, when the faucet turns off, then the money's going to dry up, and it's going to be a little more difficult. And so those companies aren't going to bring in as much money, and just like Facebook and Walmart reported recently, their profits are down for the quarter, okay? It's very unusual for those companies. But the other thing we're dealing with currently is inflation, okay? So I'm going to talk a little bit about inflation in a second, but inflation is putting a lot of pressure on the average consumer that's just trying to get by with the kind of the average income and the average job. That's a big problem. So let me pause on that comment for a second. Let me finish up this on the 30% decline. We'll talk about inflation a little bit. So after a 30% market decline, average return the next year is about 23.8. After 3 years, it's 16.4. And after 5 years, it's 50%. So a 30% decline is pretty rare. That's not very normal. So either way, we do want to stay focused, and keeping in mind that if you take your money out today, more than likely, you're going to take it out the wrong time, and you're going to put it back in at the wrong time, and then you're going to miss out, right, on these returns over these next few years. Okay, so again, try to stay focused and calm. And I know it can be stressful, but if history repeats itself, okay, which history may not repeat itself, by the way, we don't know what's going to happen for sure. But if we look at the last 90 plus years here, more than likely we're going to be better off by not making any irrational decisions. Doing things like, purchasing more, for example, rebalancing your accounts, for example, maybe looking at a Roth conversion where you move money from your pre-tax account to a Roth account. That could be beneficial. Those are things that you can do to take advantage of the current market. And the way I look at things is there's always a good thing you can do with the market. If the markets are up, great, your accounts look beautiful, everybody's happy, life is good. But if the markets are down, well, what can you buy at a discount, right? Can you increase that 401k contribution and buy more shares? And even if you did not increase your 401k contribution, if you kept your same, let's say you're putting in 10%, that same 10% of money is now buying more shares every single time you contribute, right? So that's the benefit of doing something like dollar cost averaging, which is when you put the same percentage of money or the same amount of money each month, for example. If the market's high, you're going to buy less shares. So you're going to buy less shares when the market's high, and you're going to buy less overpriced shares. And when the market's down, you're going to buy more shares, right? That's the benefit. And that's when you do that dollar cost averaging and purchase investments every single month. then over time, things will average out and you should generally have a better average cost per share when you do things like that. So good. So let's talk about our worst enemy right now, okay? We're going to talk about inflation here a little bit. So who is feeling the pain from inflation? I would love to hear if you're feeling any pain from inflation. Here in California, okay, our gas is consistently over $6 now. Everywhere I drove around the last couple of days through where I live and going over to where I go, like to the gym and things, it's $6 a gallon at a minimum. We're seeing $6.40, $6.50, and then some. Yeah, someone says everyone's feeling inflation. Yeah. If you're somebody who's on the wealthier side, and let's say you make, 150,000 a year or more, yes, you feel it, okay? But in reality, if you're, the gas I filled up the other day was $90 for a tank, okay? I drive a simple Hyundai Sonata, and for that kind of car, I do remember a few years ago, to fill up a tank was about $44. Now, just a couple days ago, I paid $90. Technically, it was $89.90, but basically $90. A few weeks before that, it was $93. So yes, the cost has basically doubled for me, okay? Yeah, Malia says inflation is crazy. Yeah, it's pretty crazy. But at the end of the day, it's $40, okay? I'm going to fill up twice a month. That's $80 a month. That is not going to keep me and my family from not eating, okay? But there are a lot of people. The average income in this country is somewhere around $60,000, okay? Somewhere in that range for household income. If you're And a lot of people commute, by the way, to work. I don't really commute. I work mostly at home. But if you're commuting to work and you have car payments or you're trying to, let's say purchase a home in the last year, it's been extremely, extremely brutal. And it can feel a little bit defeating. Okay, I completely get that. You can look at the current situation, the current economy in a couple ways. We are going through a period called the Great Resignation, where a lot of people are just quitting their jobs and they're just like, screw this, basically. I get that, by the way, because corporations, some of them did a good job, okay, when coronavirus hit, but many of them did a terrible job, and they basically just dumped people on the street and said, go get your unemployment before they even knew the unemployment and the stimulus checks were going to come. So I would be pretty irritated too. Luckily for me, I'm my own boss, so I took care, I did the best I could to take care of myself, but I understand why people are leaving their jobs. But at the same time, there is a lot of opportunities right now because companies are struggling to hire. So the ball essentially is in your court. The advantage is in your court if you're a worker to increase your pay right now, to ask for raises, to maybe change jobs. But this may not last forever. Okay, so I would be very cautious if you're somebody who is just trying to avoid working right now, because I think the tables are going to turn in the next 3 to 6 months here, and employers are not going to want to hire as much as they are today, and you might miss out on this. So anyways, when it comes to these times of inflation, just like with the stock market, you can look at this a couple ways. Like the world's ending, right? That won't be one way to look at it. Or you can leverage this to say, hey, go to your boss and say, hey, I need a raise. Everything's up. The reported inflation somewhere around 8.5%. Okay, but I don't really agree with that. I think that in my world, okay, my groceries are about 20 to 25% higher. My gas is about almost 100% higher. Okay, so it used to be $44 and now it's $90 to fill up a tank. I mean, that's almost double. And so I don't really agree with that 8.5% number. But hey, if you bring in the whole basket of things they like to manipulate and put that together, that's what they're saying. But either way, this is a great time for you to leverage this situation for you to get a pay raise, right? I would be putting a lot of pressure right now on your boss to get a pay raise. But the other thing to think about is what you're doing with your money, okay? And I know I-bonds are something people are really hot on right now, and that's not necessarily a bad thing. I-bonds are paying about 8-9%, and you can put about $10,000 or $20,000 in there in your household. You can put I think $10,000 each, and I think you put another. Don't quote me. I think it's $10,000 if you want to put them in the name of a trust. And then you can put another $5,000. I'm doing all this from the top of my head. But you can put another $5,000 from your tax return. If you're getting a tax return, you can buy another $5,000. So, okay, at most, let's say you can put in $20,000 to $35,000. It's a decent chunk of money, okay? It's definitely a decent chunk of money. But the money has to stay there for at least a year to get the interest rate. And if you take it out before 5 years, you lose 3 months of interest, okay? So there are downsides to that. But a better place to me even though the market's down right now, is to keep your money in stocks, okay? Because here's some data that I think is, to me, if it was me, okay, this is for me, really interesting. So what we're looking at here is, let me get my little pointer here. These red dots here, okay? These red dots are what inflation was in any particular year, okay? So on the left side here, on the y-axis, we're looking at percent change. On the x-axis, we're looking at year. Okay, so we have data back here from 1992 and through 2021. So the red dots are inflation. So inflation's been hovering somewhere around 2-3% average. Okay, pretty average, 2-3%, until 2021, where it's jumped up quite a bit. And 2022 is not on a good track so far, by the way. So that is inflation. When you look at the green bars, okay, so these green bars here, in these years, this is what the S&P 500 one-year real return was, okay, in that same year. So there were down years, like here, 2008, early 2000s here, we had the tech crash. But the far majority of years, we had positive returns above inflation and honestly, like way above inflation, Some years here, 30%, high 20%, almost 35% in some of these years. So the S&P 500 over this last 20 years or so has posted an average annualized return of 8.1% after adjusting for inflation, okay? So again, I bonds are great, but if you've looked at the history of what I bonds have done over time, they're great right now, but they really haven't been that good over time. They've been more in the neighborhood of 2 or 3%, somewhere in that range. And there have been higher years, of course, but if you're looking to do this for a short-term strategy, that's fine, but it's also a small percentage. So a lot of folks here have a lot more than $20,000 or $30,000 to invest. So if you're looking at $500,000, $1 million, $2 million, for example, $20,000 or $30,000 is great, but it's not going to change your life to get an extra $900 this year on that portion of money. It is nice to get the $900, so take it, put the money there, nothing wrong with that. But you are adding complexity to your life because now you have to have another login at the Treasury site. And it's something that the money's locked up for a little bit, right? So your funds aren't necessarily available. So again, not the end of the world to do I bonds. But if you look at, keeping money in your equities, it's a bad year. Okay, we're not looking good so far. Things could still turn around, but again, it's not looking great, let's be honest. But over time, the stock market has definitely done better than inflation. So I still think, keeping your money in the markets is a very, very good place to be for the long term. But there are some stressful periods on the short term, to be dealing with like we're currently dealing with today. So that's what I have for you, okay? So what are my takeaways? What are the takeaways I want you to have? Let me get this out of here. So what are the takeaways I want you to have? So the takeaways I would want you to have are, number one, stay focused, okay? Don't make short-term decisions, okay? When you're investing your money, you're investing it for the long term. Okay, you knew when you signed up that the market could go up and down. Very few people like to see the market go down. I understand that. But what we have to do is understand that most years it's going to go up. And when it goes down, how can we take advantage of it, right? Can you increase your contributions to your savings accounts? Can you look at something like a Roth conversion? Again, if you don't know what that is, I have other videos that I've done about that and you can search those. Can you rebalance your accounts and find some deals that are out there on funds that you might own that are extra down that you can sell something else off? Or you have some cash sitting on the sidelines that you can put some money in. All those behaviors are market timing behaviors, okay? So I want to encourage you not to focus too much on market timing behaviors. But at the end of the day, by keeping your money invested for the long term, you're going to be in a better spot than you will be most likely than if you try to jump out of the market today and put it back in at somehow get the magic time right later. On that note, a lot of folks here are close to their retirement timeframes. So there are 3 stages when it comes to saving, investing your money that you got to think about. And 2 of them you're probably very familiar with, but one of them you probably forget quite a bit. So the first one is accumulation, right? So if you're saving your money, you're still working, you're in the accumulation stage, and you have hopefully years to go. The other stage is decumulation. That's where you're spending down your accounts and you're in retirement. So maybe you're somebody who's in that decumulation stage, and that's just probably the most stressful for you if you're here. But a lot of people forget about the middle stage, okay? The middle stage is called preservation, right? Preservation. And so if you're somewhere within 5 years of retirement, What you should really be thinking about right now is setting up your accounts so that you have the right amount of money in growth assets, the right amount of money in safety assets, and the right amount of money in moderate assets. Because you need a little bit in all three of those buckets so that you're prepared for situations like this. Okay? Situations like this can last years potentially. So if you have the right amount of money in safety, moderate, and growth, you're probably not stressing out too much right now. I have a lot of clients that I've talked to that they're doing just fine because we have the right amount of money in the right buckets. So if that's you, if you're somebody who's getting close to retirement and you're not sure how you should be setting up your accounts, then I would love to throw out there an offer to help you, and I'll throw up my website in just a second here. But you need to get some help, okay? This is not something that you should be doing alone if you're not sure what you're doing. I highly recommend you get some professional help, whether it's from me or another professional advisor. I do think everybody should have somebody in their corner that's helping them guide them through this situation and making sure their accounts are all doing the right things at the right time. So if you have any questions, go ahead and drop those in the chat. I'm going to put up my website in case you want to get some help or you want to talk about your overall situation. But I'm going to see if there's any questions as well. So I'll stay on for a few moments. So for those of you, this is your first time doing these workshops or joining the workshop, thank you so much for joining. Thank you so much for watching. I'm going to try to do these, every Tuesday, every other Tuesday. So Tuesday at 2 Pacific is my goal. 2 a month right now is pretty good. I got a baby coming, by the way, so I think some of you know that. But I got a baby due in July, so that may be a little inconsistent if that something happens earlier. But Tuesdays and 2, you should be able to see me here and join for these workshops and ask any questions. So if there's no questions, that's fine. But what I want to do is throw up my website. Let's see if I can actually get this posted here. There we go. Okay, so if you go to keepitsimplefinancial.com/talk, you can find my calendar page there. What this is for is a complimentary consultation to where we can discuss your current situation. What we're generally going to do is spend about 45 minutes or so to dive into your overall retirement situation and figure out, where you're at. And if you're not in retirement, that's okay, by the way. I found a lot more accumulators are scheduling lately. But we're going to dive into your overall financial situation, and we're going to talk about things like, are you on track for retirement? How do things look? Is your money in the right places? What are going to be the biggest concerns for you going into this next stage? These are all things we can discuss there. Many people want to know, do they have enough money for retirement? To be honest with you, I can't answer that in 45 minutes, okay? But what I can do is help you create a game plan and help you recognize, okay, here are the main things you need to do, the main action items you need to do to prepare yourself or to get your situation in the right order. And if you want some help with that beyond our conversation, obviously we can talk about that as well. But this is a complimentary consultation, so I'll be happy to help you. And I do have a few time slots available before I'm going to be taking some time off for the baby. So if you do want to discuss this, if now's the right time for yourself, I would recommend getting an appointment sooner than later because I will be closing my calendar for a couple months probably while I deal with this baby thing because this is my first one, if you guys didn't know. And I don't know what's going to happen, okay? I got all kinds of people around me freaking me out, telling me that the baby's not going to sleep. You're going to be feeding every 2 hours and you're going to be like sleeping 2 or 3 hours a day. I don't know, okay? I'm hoping my baby's more like my wife. Okay, my wife, she loves to sleep. She'll sleep 8 hours, 9 hours, no problem. If the baby is like me, it'll be sleeping 4 or 5 hours, maybe 6 hours on a good day, and it's going to be a lot of fun. So we'll deal with that as it comes. But I'm going to take some time off to focus on that. So let's see if there's any questions here. So Tamara asked about addressing I bonds. Yeah, so definitely happy to discuss further, but that's what I'm looking at there. So Sean asked about what equities to put in, growth value, S&P 500. So Sean, this is where I have to be careful about crossing the line here and giving specific investment advice. But the S&P 500 is essentially a mix of growth and value. If you look at the returns of different portions of the market over time, technically over, let's say 50 or 100 years, value has done better than growth. So if you wanted to tilt a little bit extra and have a little bit more value, over time it's done better. The last 7 or 8 years has not been the case at all. Growth has done better than value. But if you're looking at 20, 30, 40 years, value has outperformed growth. What sometimes people forget is there's a small cap index as well. So when I mentioned here the Russell 3000, that's going to include the small cap index. So that's the S&P, like I said, plus another about 2,000 companies. So I wouldn't leave that out. I would really consider including that in your overall allocation. The small cap index has done better than the large cap index overall. But again, recent times has been a little bit more up and down. And then I would definitely be thinking about diversifying internationally as well. International has not done that well the last 10 years. But if you go from January 2000 to December 2009, in my world, we call that the lost decade. The S&P 500 did negative 9% during that decade, okay? So even though international has not performed as well as domestic, which would be US, the last 10 years, I still think it's a good idea to have some in there because you never know when these returns are going to show up. And over time, things seem to do better if you're globally diversified. So if we go over the last 5 decades, 3 decades, a globally diversified portfolio did better. 2 decades, the S&P did better. So again, I can't give you investment advice here, Sean, but that's some overall general guidance for you to be thinking about. Thank you, Malia, for the congratulations on the baby. I appreciate that. So folks, I am not seeing any other questions. So like I said, if you have any individual questions, you can schedule a call on my site here. I'm going to put the link down in the chat as well, or in the comment section. I would love to speak with you. But other than that, I'm going to sign off for today. I wish you a wonderful day. Thank you so much for watching. And if you have any further questions or if there are any other videos you'd like me to do for you, go ahead and just send me a message and I'll be happy to discuss that. Have a great day and we'll see you next time. Okay? Bye now.